So, what will inflation and taxes do to your retirement? Inflation and taxes. Two things that tend to have a very high likelihood of going up in the future. Now, many retirements these days are lasting 30 years or more. We're living longer, so the aspect of having less purchasing power due to inflation and having less spendable income after tax increases is causing some less than restful nights. So let's look at a little of our process and some of the reasons why we do it the way we do it. Now, the average inflation rate, decade by decade, over the last 100 years is just over 3%. Now, it's been as low as negative 2%, which you might think that would be great, but that was during the Great Depression in the 1930s, so we really don't want to go back there. And it's been as high as just a little over 9%, which was during the World War I decade, and we don't want to go back there either. But recently it's been right around 3%, and that's the average, so that's kind of what we use. So let's look at a couple examples of income needs so you can see what it could look like with inflation by the time you hit your 90s. And I'm going to use $75,000 and $100,000 incomes. Now, most people are retiring sometime in their 60s and they're enjoying a pretty long retirement. So we figure for the majority of people, your retirement could last around 30 to 35 years. Now, if you kept your lifestyle and expenses the same year after year, a 30-year retirement starting with a $75,000 lifestyle would end up just north of $184,000 a year. Whoa. And if you start out with a $100,000 lifestyle, by the time you hit your 90s, it's going to be over $245,000.
Holy cow lookers!
Now, that may seem a bit outrageous, so just think about this. I'm guessing the majority of you are not going to be taking trips and doing the same things in your 90s like you would take trips and do things in your 60s and 70s. Your lifestyle needs and spending habits are most likely going to change throughout your retirement. And this is what is referred to as the retirement spending smile. You have your go-go years where you're the most active and you spend the most money, having the most fun. And this phase could last until your upper 70s or low 80s, depending on how healthy you are. Then you have your slow-go years, which you still have some fun, but you're taking it a little slower and things might not be so elaborate. Now, this phase would be somewhere in your low to mid 80s. Then you have your no-go years where you don't want to or really can't go anywhere. Now, this can be your upper 80s and beyond. And this is the phase when medical expenses usually start to increase your expenses. And maybe you saw this with your parents or some other family members. So knowing that this phase is coming, it can make some retirees lose a little sleep. You just don't know for sure if your income will be sufficient if some of these bills have to come out of your pocket or your investments. One part of our trademarked resuscitation report is an income analysis. This will tell us if inflation will reduce your likelihood of a successful retirement. And our definition of a successful retirement is you have money left over at the end and you don't have to worry. We run 10,000 different simulations with several different scenarios to see if your income and assets are going to keep up. This factors in inflation, taxes, healthcare costs, and several other factors and events that could occur to see what it could do to your retirement. Now, if you want to sleep better at night with this kind of knowledge, just click the link on the screen to take the next step. Now, I mentioned taxes are a part of this analysis, so let's take a look at how taxes could impact your retirement. Now, inflation is one factor that, at least in recent decades, doesn't take huge jumps. Taxes? That's a whole nother monster. Most advisors don't go into much future tax planning because they don't have the training. Maybe they'll refer you to a good tax preparer. Now, I have to stop right here because I just used a couple words that might sound similar, but mean two completely different things. Tax planning versus a tax preparer. What's the difference? Well, what's the job of a CPA or someone who prepares your tax return? Well, basically it's to keep as much money in your pocket based on what you did last year. Now, that's good, but it's kind of a snapshot look at a full-length movie. We look at short-term and long-term. Tax planning helps you pay the least amount of tax throughout the rest of your life. And sometimes getting a small tax deduction year after year while you're working by contributing to a 401k or other IRA can create a huge tax liability down the road when you're retired. Now, if you have qualified accounts, meaning you got a tax deduction when you put money into an IRA or a 401k, 403b, 457 TSP, stuff like that, you're going to have to pay taxes on all your contributions and all of the growth when you take that money out. And would you say that taxes are going to go up in the future? Of course. I've never heard anybody say taxes are going to go down in the future. So why are we wanting to pay taxes later when we think taxes are only going to go up? Because we were told that when we retire, we won't be working and thus we'll have less income and be in a lower tax bracket. Well, sadly for most Americans, that ain't the case. Most of our clients and the people that we see, they're in the same tax bracket when they retire. And two of the biggest reasons for that are most of their deductions are gone and they don't want to reduce their lifestyle. I mean, would you want to cut your lifestyle? No. Retirement is a time to have more fun. So who sold us this idea? The IRS. And isn't it funny, they're also the ones who stood to benefit the most from this strategy. Now, outside of tax rates going up, what are some things that could increase your taxes? Well, if you have a pension, you might pay more in tax. If you've done a good job saving for retirement in a tax-deferred account, when you hit required minimum distribution age, which is 72, you might pay more in tax. If you're single, or if one spouse passes, you're probably going to pay more in tax. Now, how do you find out what your current tax map in retirement looks like? Well, part of our resuscitation report that I mentioned analyzes what your taxes could look like as you go throughout your retirement, at least based on what we know about the tax landscape in the near future and what your situation is. And if you want to find out what your tax map for retirement could look like and find strategies to lower your overall tax liability, just get a hold of us to find out if we can help. And if you're the kind of person that takes action on your important decisions and would like help answering any or all of the questions for your retirement, go ahead and click the link below for a simple 15-minute complimentary phone consultation to find out if we can help. And if you like learning on the go, head on over to our podcast and YouTube channel, Retirement Rescue Radio. You can use it as another tool to help you navigate your retirement. Our next video will address your questions on what else the government can control that can affect your retirement. Again, make sure to subscribe to our channel and hit that notifications bell so you don't miss any answers to your retirement questions. Live the retirement you deserve.